Imagine you build a business that is growing at 25% a year.
Which, I mean, is an incredible top-line number for retail right now.
Right. You are selling premium, globally recognized luggage and accessories, think Tommy Hilfiger, to a rapidly expanding Indian middle class.
The revenue growth looks absolutely spectacular on paper.
It does. But now imagine that for every 100 rupees you make, you get to keep less than a single rupee in profit.
Yeah, that is the terrifying part of this whole equation.
Welcome to the Deep Dive. Today we are exploring the Financial Highwire Act of Brand Concepts Limited, or BCONCEPT.
It's really one of the most fascinating paradoxes in the consumer discretionary space today.
We have stacked up a huge pile of detailed stock stories, financial excerpts, and market analyses. And our mission for you today is to unpack the reality of a company operating right at the intersection of Indian consumer premiumization, omni-channel retail strategy, and just cutthroat margin pressures.
We're looking at a business with roughly 348 crore in annual revenue and a market cap hovering around 242 to 252 crore.
Which is relatively small.
Right, very small. But they are surviving and attempting to rapidly scale in an environment where massive entrenched legacy players usually dominate.
Okay, let's unpack this from the foundation up. Because before we look at that massive market opportunity or, try to solve the mystery of those razor-thin margins, we really need to understand the fundamental identity of brand concepts.
Yeah, because when you first look at them, they seem to have a bit of an identity crisis.
Exactly. They aren't a traditional manufacturer pulling raw polycarbonate out of a vat and stamping their own name on it. So are they a creator? Are they a curator?
Well, their core business model is built entirely around being a branded accessories platform. They sell travel gear, so that means hard and soft luggage, backpacks.
Right.
And that sits right alongside women's handbags, belts, wallets, and small leather goods.
And how are they actually moving all this product?
Through a deeply integrated omni-channel retail and wholesale model. They have their own physical stores, they push volume through online marketplaces, and they have this sprawling network of wholesale distributors.
The illusion, though, is the brand itself. Like you walk into a store, you see a premium Tommy Hilfiger suitcase, and you just assume Tommy Hilfiger made it.
Right, but that is the absolute core of their license strategy.
Which is fascinating.
It is. BCONCEPTS leans heavily on licensed brands. Tommy Hilfiger, Head, ND, Global Desi.
So they don't own the brands?
No, not at all. They handle the local design adaptation, they manage the distribution, and they run the retail operations. But they operate entirely under the umbrella of those licensed global and national names.
Okay, wait. So they are essentially just a hyper-connected curator.
Yep.
They are renting the global cool factor of a brand rather than spending 50 years and billions of dollars building that brand equity from scratch.
That's a great way to put it. They rent the equity.
But doesn't that just make them a glorified middleman? I mean, if they don't actually own the brand equity, aren't they just moving boxes from a factory to a mall and taking a tiny cut?
In a basic commodity market, sure, a middleman is just moving boxes.
Yeah.
But in the fashion and consumer discretionary space in India, that middle layer is an incredibly complex, highly valuable operational moat.
How so?
Because being a branded accessories platform means mastering distribution, shelf appeal, and regional retail nuances. The raw materials, the nylon, the zippers, the plastic, those are secondary to the massive logistics of getting a specific localized design onto a premium shelf in Mumbai or Bengaluru.
Right. The execution is the hard part.
Exactly. They operate in the exact same organized arena as giants like Safari Industries and VIP Industries.
Because a global licensor sitting in New York doesn't want to navigate the labyrinth of Indian state-by-state retail distribution.
Oh, absolutely not. They don't want to figure out the local real estate market for mall space or manage a fragmented network of regional wholesalers. They just want their royalty check and their brand protected.
And that is the exact friction BCONCEPTS eliminates.
Precisely. They provide that localized execution layer. The global brand gets penetration into one of the fastest growing consumer markets on earth without deploying massive capital.
And Brand Concepts gets to sell a product that already has immense consumer pull.
It's a symbiotic relationship, at least while it lasts.
Right, while the license is active. So if they have the right global brands on the shelf, the next logical question is, who is walking down the aisle to buy them? The TAM here is massive, but it's not just one big monolith.
No, the consumer psychology changes wildly depending on which zipper you are opening. Let's break it down segment by segment, starting with travel gear.
Luggage and backpacks.
Right. The demand here is driven by frequent travelers, business professionals, students, and just The broader expansion of leisure travel.
The replacement cycles are fascinating here, though. I mean, you don't buy a hard shell polycarbonate suitcase every 6 months. That is a multi-year purchase.
Exactly. You buy it and expect it to last.
Ugh.
But a backpack, a student or an office worker might replace that every single year, or maybe every 2 years.
So the velocity is completely different.
Yeah. The luggage volume relies on the macro-level expansion of the traveling class, while the backpack segment benefits from a much higher frequency of replacement.
Got it. And then you shift over to small leather goods like the belts and wallet.
Right. This is everyday utility for the working-age population. The revenue per user is pretty modest here. A wallet simply does not cost what a premium suitcase costs.
But again, the replacement cycle is fast. A wallet gets worn out, belts get replaced, and the gifting culture in India acts as a massive catalyst for this specific segment, doesn't it?
Oh, massive. It is a low-friction, high-utility gift. Corporate gifting during Diwali alone drives huge volume in this category.
Yeah, that makes perfect sense.
Next, consider women's handbags. This is arguably the most structurally attractive category in their portfolio.
Because of the fashion element.
Exactly. It is the ultimate blend of functional utility and high fashion. Handbags are incredibly trend-sensitive. A consumer isn't just replacing a bag because the strap broke.
Right, they are purchasing multiple bags to match different seasons, different outfits, or different occasions.
You are capturing multiple purchases from the exact same consumer over a single year,
And finally, you have the broader accessories category.
which is characterized by broad usage, low to moderate ticket sizes, and heavy impulse buying. You are at the checkout, you see branded accessory, and you just throw it in.
So when you aggregate all these segments, the structural growth drivers pushing the entire market upward become very, very clear. The expansion isn't reliant on some aggressive, untested assumption about human behavior.
No, it is built on undeniable macroeconomic shifts. Rapid urbanization is pulling more people into environments where branded accessories carry social currency.
And you also have the formalization of the workforce. As millions transition from informal work to corporate or organized sector jobs, the immediate requirement for formal belts, professional laptop bags, and structured wallets skyrockets.
Add to that the post-pandemic explosion in both domestic and international travel. People are on the move again.
And underpinning all of this is digital adoption.
Yes. The ability for consumers outside the top-tier metropolitan areas to discover and seamlessly purchase premium brands online has fundamentally widened the funnel.
But let's look at the reality of their current scale. BCONCEPTS is sitting at around 348 crore in revenue. In a country with over 1 billion people and all these structural tailwinds, urbanization, formalization, travel, why is their market penetration still so relatively low? I mean, they're barely a drop in the ocean of the total Indian retail market.
Well, because the market they're operating in is still intensely fragmented. The runway is massive because the vast majority of the demand is currently being captured by unorganized, regional, or completely unbranded players.
Right, so the low penetration isn't a lack of demand for bags.
Not at all. It is a reflection of the fact that millions of consumers are still buying unbranded products from local markets.
So their entire growth thesis is just a massive bet on premiumization.
Exactly. It is the belief that as household incomes rise, that specific consumer will upgrade from a generic 500 rupee bag to a licensed premium Tommy Hilfiger backpack.
It is the migration from the informal economy to the formal branded economy.
And because these are recurrent, durable consumer needs, the demand isn't a fleeting fad. People will always need to carry their laptops, they will always need a wallet, they'll always need luggage for a flight.
Okay, so we know the market is huge. We know the consumer behavior driving it. But in a fragmented landscape where theoretically anyone can import bags from overseas, how does Brand Concepts actually defend its territory? How do they protect their moat?
Their primary weapon is differentiated shelf appeal. And that advantage is entirely locked up in their licensed brand access.
Which is hard to replicate.
Phenomenally difficult. It is incredibly hard for a generic competitor to secure an exclusive franchise or trademark agreement with a premium label. You have to demonstrate localized design capabilities, protect their global brand equity, and possess the physical infrastructure to actually move significant volume.
Okay, so the brand access gets them in the door, but the actual execution happens through their omni-channel footprint. Let's look at the physical reality of their retail reach.
Right, let's look at the numbers. They operate 8 COCO stores, so that's company-owned, company-operated.
Okay.
They have 22 FFO stores, which are franchise-owned, franchise-operated. and they run 30 exclusive brand outlets, or EBOs.
That specific mix is really crucial, isn't it?
It is. The Niso sales stores allow them to tightly control the premium customer experience in flagship locations. They want complete control over how the brand is presented there.
But the FOFO model is the actual growth engine.
Yes. A franchise-owned, franchise-operated store means BCONCEPTS is not tying up its own precious capital in a long-term lease in some Tier 2 city.
The franchise takes the real estate risk.
Exactly. While BCONCEPTS expands its geographical footprint and brand visibility without burning through its own cash.
But I have to push back here. When I look at their entire operation based on the sources, I see a glaring vulnerability. There is absolutely no traditional cost moat.
Fair point.
They don't have a proprietary patented manufacturing process that makes their polycarbonate luggage 20% cheaper to produce than Safari Industries. They don't have some revolutionary software platform.
No, they don't.
If you lack a structural cost advantage in a physical goods business, aren't you essentially just crossing your fingers and hoping your brand licenses never expire?
What's fascinating here is that you've hit on the exact vulnerability of the model. The moat is moderate at best.
At best.
Yeah, they have incredible commercial traction today, but it is not an unbreakable structural fortress. The switching costs are somewhat sticky for the brand partners. I mean, firing your local licensee and building a new supply chain is a massive headache for a global brand.
Right.
But the loyalty of the end consumer is a completely different story.
Exactly. If I walk into a mall to buy a Tommy Hilfiger bag, my loyalty is to Tommy Hilfiger. I have zero allegiance to Brand Concepts Limited.
None.
If Tommy Hilfiger transfers that license to a different distributor tomorrow, I will just buy from the new distributor without a second thought. The consumer loyalty completely bypasses the aggregator.
Which means Brand Concepts is on a perpetual treadmill. They have to continuously execute flawlessly just to keep the licensors happy.
Their only value proposition to the brand owner is their distribution reach and retail execution. The moment that slips, the license is gone.
And this lack of a deep structural cost advantage brings us to the most shocking part of their story, the financial paradox.
Let's dig into the numbers because they are genuinely jarring.
In Q4 of FY 2025-26, they posted revenue of 90.93 crore. That is a massive 25.01% year-over-year growth.
Any management team in the retail sector would be absolutely celebrating 25% top-line expansion.
They would be popping champagne. But then you look at the bottom line. On that 90.93 crore of revenue, the net profit was a mere 0.88 crore, just 88 lakhs.
Wow.
That means their net margin has collapsed to an incredibly fragile 0.97%, down from 2.14% previously.
They're growing sales by a quarter, yet their profit margin is essentially a rounding error. How does that even happen?
The main culprit right now is their current transition to in-house manufacturing. Historically, Brand Concepts operated a very asset-light model, relying heavily on outsourced manufacturing.
Right, letting someone else run the factories.
Exactly. But now they are shifting toward producing in-house. And that shift is acting as a massive, heavy anchor on current profitability.
Because setting up manufacturing facilities means incurring massive upfront expenses.
Huge. Machinery, factory leases, specialized labor, overhead. They're paying all the elevated expenses of running a factory, but they haven't reached the scale or the utilization rates required to actually realize the efficiencies of making it themselves.
The gross margin is just being eaten alive by the factory overhead.
The mechanics of factory economics are brutal. When you build a facility, your fixed costs are identical, whether you produce 100 bags or 10,000 bags.
Right, the rent is the same.
Exactly. Until your volume scales up to fully utilize that factory floor, the cost per bag remains astronomically high.
It's like running an ultramarathon, but you are breathing through a cocktail straw. The legs are moving, the pace is incredible, that is the 25% revenue growth.
Right.
But the oxygen intake, the profit margin, is so severely restricted that collapse feels like it is always just one bad step away. Are these just temporary growing pains, or is this a permanent feature of their business model?
That is the perfect way to visualize it, and it all comes down to operating leverage. Right now, the business is absorbing massive fixed cost investments, not just the manufacturing plants, but corporate overhead, expanding digital marketing teams, and the rents on their new exclusive brand outlets.
So the thesis, the light at the end of the tunnel, is that once they cross a specific volume threshold, every additional bag sold drops almost entirely to the bottom line as pure profit.
Because those fixed costs are already covered. If the volume continues to accelerate and outpaces the fixed costs, the margin will expand. That is the operating leverage finally kicking in.
But if that volume growth slows,
If it slows, or if they continue piling on fixed costs ahead of the revenue curve, a 0.97% margin is a massive, blinking red warning light. It exposes a fundamental fragility at their current scale.
despite the brutal margin compression on the income statement, there is a weird silver lining hiding in their cash flow metrics. Their working capital requirements have actually improved significantly.
Yeah, dropping from 33.5 days to 24.6 days.
Which is huge, because in a physical inventory business, working capital is the lifeblood. Cash gets trapped constantly. It gets trapped in raw materials, it gets trapped in finished bags sitting in a warehouse, and it gets trapped in receivables when you sell to a wholesale distributor on credit.
Exactly. And by compressing that cycle from 33.5 down to 24.6 days, they are liberating cash. They're converting inventory back into usable cash almost 10 days faster.
Which they desperately need. When your net profit is only 88 lakhs for the quarter, you need every single rupee of cash flow just to keep the lights on and fund the next manufacturing run.
So operationally, at the warehouse and the channel level, they're actually becoming remarkably efficient, even as the P&L takes a beating from the manufacturing overhead.
Okay, so knowing that their margins are under this immense pressure, how is management attempting to maneuver out of this tight spot? What is the strategic roadmap from here?
The primary lever they're pulling is premiumization. They are actively shifting the portfolio mix toward higher ticket items.
Hence the recent introduction of premium brands like Off-White and Superdry into their ecosystem.
Exactly. Moving from selling a mid-tier wallet to a premium streetwear brand significantly increases the ticket size and, theoretically, the gross margin per unit.
And they also investing heavily in capacity to support this shift, right? We are seeing a newly announced 35 crore capex plan alongside the opening of 5 new stores.
They're building the physical infrastructure required to move these premium goods. And they are also pushing hard into ecosystem expansion and the digital shift.
Leveraging their proprietary online channels and optimizing their presence on third-party marketplaces.
Right, to capture the ongoing formalization of Indian retail. They want maximum visibility wherever the consumer is browsing, whether that's a mall or a smartphone.
But the roadmap also includes a strategy labeled New Geographies, and I have to push back on this. If you can barely squeeze out a 1% profit margin in your home territory, isn't expanding internationally or to untested cities incredibly dangerous?
Your skepticism is entirely warranted. There's a very sharp distinction between their growth vectors here.
Deepening the penetration of their existing categories, like selling more luggage to their current urban demographic, seems structurally sound.
Highly credible. The demand is proven. But broad geographic expansion without a margin buffer is incredibly dangerous.
Because opening a store in an untested Tier 2 city requires upfront capital. You are paying rent, you are paying staff, and you are funding local marketing before you sell a single bag.
Right. And if a new store takes 12 months to break even instead of 6, a company with a 0.97% net margin doesn't have the shock absorbers to handle that cash burn.
It could pull the whole company down.
It is highly execution dependent. The deeper penetration strategy is calculated and safe. The geographic expansion strategy is fraught with vulnerability.
Which perfect transitions us into the fragility of the model and the downside risks that could break this entire operation apart.
The primary threat is intensifying competition. The premium luggage space is not a blue ocean. They are fighting against competitors with far deeper pockets and significantly wider margins.
And those competitors can afford to discount aggressively to steal market share. If a competitor drops their price by 10%, BCONCEPTS has to match it to maintain velocity.
But they don't have 10% of margin to give away.
They don't even have 1%.
Exactly. And it isn't just physical retail discounting. If the third-party online platforms alter their algorithms and reduce BCONCEPTS' organic visibility, the company is forced to ramp up digital marketing spend just to acquire the same number of customers.
That directly crushes an already fragile margin.
Then you have the physical realities of the supply chain, input cost volatility. A weaker rupee makes any imported materials more expensive.
Wait, here's where it gets really interesting. Let's do the math on this right now. They did roughly 91 crore in revenue for the quarter. Net profit is 88 lakhs. That's less than 1 crore.
Right.
If their freight and logistics costs unexpectedly go up by just 1 or 2%, maybe fuel prices spike or container costs jump, that 88 lakhs is instantly vaporized.
Entirely wiped out.
Because the net margin is so thin, even a tiny 2% increase in logistics costs completely wipes out the company's profitability. It's a high-wire act without a net.
It is entirely unforgiving. And beyond the financial metrics, there are structural vulnerabilities. Key person risk is massive here.
Oh, because of the brand relationships.
Yes, they are navigating complex trademark laws and import regulations, and the reality is that the relationships with the global brand owners often sit with just one or two key executives.
So if the executive who holds the relationship with Tommy Hilfiger decides to leave the company, does the license leave with them when it is up for renewal?
That's the billion-dollar question. In a business where your entire moat is renting someone else's brand, your relationship with that brand owner is the single most critical asset you have.
So with all these compounding risks, the aggressive competition, the input cost volatility, the key person dependencies, and the near zero margin for error, why hasn't the model fractured yet? How are they still posting 25% revenue growth?
Because right now, the brand access remains intact. The Indian consumer still deeply desires Tommy Hilfiger and Superdry, and BCONCEPTS is still the platform putting those products on the shelf.
So the sheer momentum of top-line revenue growth is currently outrunning the margin compression.
Exactly. The machine is moving forward fast enough to prevent it from stalling out, but the protection is incredibly thin.
When a business is executing a high-wire act of this magnitude, you have to look very closely at the leadership. Who are the acrobats actually running the show?
The key figures driving the strategy are Pratik Maheshwari, the chairman and managing director, and Abhinav Kumar, the whole-time director and CFO,
It is a founder-led, operationally active management team.
which is generally a positive signal in retail, where daily execution on the ground dictates success. You need leaders who know how a store actually operates.
But there are some notable governance and disclosure limitations as well, according to the sources.
Yes. While the board includes independent directors like Govind Shrikande, who brings immense experience from the consumer sector, there's a frustrating lack of transparency on several fronts.
For instance.
While there is no distinct disclosure regarding a separate CEO role, the exact compensation structures aren't fully detailed in the materials, and there is a lack of deep clarity regarding minority shareholder treatment.
We have to evaluate them on their actions then. Look at their capital allocation. Management is heavily reinvestment-led.
Right? There are no major dividends being paid out, no share buybacks mentioned. Every available rupee is being pushed back into the engine.
They are acting decisively. We see the 35 crore capex plan rolling out for capacity and store expansion, alongside an influx of 20 crore via promoter warrants.
They are injecting capital directly into the business to fund this specific growth phase.
So they are fueling the machine, but the broader question for you listening is, what should you make of a management team that is successfully driving 25% revenue growth, but consciously allowing margins to slip below 1% to fund a massive manufacturing transition and retail expansion?
Is this visionary long-term building where they capture the margin leverage later, or is this reckless growth at any cost?
What's your takeaway on their capability?
Their operational competence at a mid-sized scale is proven. They successfully navigated the post-FY24 rebound in demand. They know how to open stores and move inventory, but they are completely unproven at high scale. Managing 30 stores and an outsourced supply chain is fundamentally different from managing 300 stores and running your own manufacturing plants.
It's a completely different sport.
They are transitioning from a nimble player into a complex, integrated retail platform, and it remains to be seen if they can execute that leap profitably.
It is a phenomenal pivot point for the company. So what does this all mean for you? Let's synthesize the reality of Brand Concepts Limited.
They are undeniably a fascinating vehicle for the Indian premiumization story. They have secured the right global brands, they are aggressively expanding an omni-channel distribution network, and they are capturing incredible top-line revenue growth.
But that growth is exacting a severe toll on the balance sheet. They are battling immense margin compression, driven by the heavy fixed costs of shifting to in-house manufacturing, while simultaneously fighting off intense competitive pressures.
They are a platform surviving on less than a 1% net margin, betting that scale and operating leverage will eventually bail them out.
It is the ultramarathon runner breathing through a straw, hoping they cross the finish line before the oxygen runs out completely. And as we wrap up this deep dive, there is one final, broader question you should consider the next time you walk through a mall.
Look at the trajectory of global retail. Massive global luxury and lifestyle brands are increasingly recognizing the undeniable power of the Indian consumer market. Right now, they rely on local, specialized platforms like BCONCEPTS to navigate the complexity.
Because it's hard.
It is, but as digital distribution becomes globally seamless, And as these global brands gain the confidence to operate directly in India, will they continue to rely on local curators?
Or will they eventually cut them out?
Oh,
Will
yeah.
they shift to a direct-to-consumer model, leaving companies like Brand Concepts without the very licensed assets that currently define their entire existence?
It is the ultimate existential threat for any aggregator.
Thank you for joining us on this deep dive. Keep questioning the margins, the supply chains, and the underlying mechanics behind the brands you see on the shelves.